European stocks enter a corrective phase as they continue to decline. So many issues presenting themselves within the EU at this time, whether it is the deflationary pressures, the geopolitical tensions, the growing income inequality, or the disruptions of the social order, we find constant reasons for the market to be moving downward. No worries, the ECB is there to save the day. You came here for the truth, so let me unveil that for you. Today we are going to have our focus on Europe. Let's begin. You can see the Europe Stocks 600 moving into officially a corrective phase, going down by 10% here from the highs, and this is not the only market to have done the same thing. So could this be a global event that's taking place, a corrective phase, or will we retrace our steps? So we'll take a look at a few indicators, but I want you to be able to judge what's happening for yourself, because ultimately you have to manage your own money, your own investments, your own time. So knowing all of the different indicators that are out there, all the important ones, you can make better judgments. So I just wanted to show you here first that as of the close on March 26th, European equity benchmarks close lower. So that is a continuing thing that is occurring here. But despite all of these programs that have been put into place, these markets are still weak. And one that is very, very important globally is the CSPP, that is the European Central Bank, the ECB, their program to purchase corporate debt. And it's important to look at something like the CSPP and understand what it is. For those who have been watching this channel, you've heard it before. For those who don't know, essentially what they are doing is bailing out all companies within the EU. And they do so by buying up their debt. So they can essentially bail them out without officially bailing them out. And that's what's occurring here at this time. It is a very bad policy because ultimately they have this moral hazard that is taking place that's not going to be addressed at any point. All you need to do is bail out the corporations and everything will be okay. Well, it doesn't work like that. It never has, never will. Where do they get the money to bail out these corporations? Well, of course, they have a printing press and they are able to generate as much money as they want, print it up, and be able to, in this case, bail out companies. It's not a good program simply because it doesn't fix the issues that are present. There is a massive level of deflation that is taking place in Europe, as well as Japan, for example, and other places too. But printing money hasn't resolved it. They've printed a lot of money and they're still doing so, but it hasn't resolved anything thus far. And we see the markets declining now by 10%. How will they be able to reverse course? They've said that they want to reverse their policies of the CSPP. They don't want to print any more money. They want to reverse that. How will they ever do that? If the markets are declining, they're not going to be able to do what they said they would do. Here are some of the markets here, looking at the DAX and others coming down. Depending on which market you look at, some are worse than others, but ultimately you can see a corrective phase that is taking place here at this time. All of this while we have seen unprecedented levels of monetary easing. So why? Why have the markets come down? If they're assured that the Fed, the ECB, and others will be there to backstop any losses, why in the world would they be coming down? I mean, that's the reason they've been going up, because they've understood that we don't need to worry. The Fed will be there to backstop anything. They've bailed out corporations all over the world before, so why not? Why not this time? Well, of course, the fundamentals show their true selves every so often. This happens to be one of those periods of time. It could definitely reverse that and go up from here. However, this is what we are seeing today. So you can see that bank stocks, whether it's in the EU or US, have declined significantly. And this is concerning because the bank stocks are ultimately able to profit off of these policies that have been put into place by the central banks. And despite the fact that interest rates are extremely low, that spread in between the central bank interest rate and the rates that they charge customers are very high. So they've been profiting off of all of this, even though historically that wouldn't be the case. All right. So the banks also, because of what we had seen during the financial crisis, we saw the weakness appearing in the banks, and then that started to unravel all of the derivatives, because these aren't really banks per se, but they are really just, casinos when you actually look into the statistics of each of them. Now, speaking of central bank monetary easing, you can see for yourself the global central bank balance sheet, just going back only from basically the past 2 years, and take a look what has happened. Sure, it has been directly correlated with global stocks. I've shown you this before, and I'm glad to see this new chart being presented here, showing us that throughout 2018, we had the same things happening. Now, we had this corrective phase here that's taken place, but ultimately, if things progress the way they have since, at least in this chart here, 2016, we can expect that markets may come up. Who knows? Or the central banks are reducing their positions. If they intend on doing that, then the market will be corresponding to that. They have tapered off, at least the Fed has, and then you look around the world and see other central banks haven't really let their foot off the gas. So this here, regardless, so we're in 2018 at the time of the recording of this video, whether you look at it for 2019 and beyond, what exactly will be the result of all of this? 2019, 2020, 2021. What will the balance sheet look like beyond 2019? You have to think about this for a moment here. We are basically now through 3 months of this year. We had seen into January, everything was looking fine and dandy. And then in February, we saw some sense of reality. And things have really changed ever since. Volatility has picked up, and there have been major concerns geopolitically. Understand what's going to happen with these interest rate hikes, looking at the bank balance sheet, because really that's all that matters. You don't have to look at jobs numbers because they're fake. You don't have to look at unemployment numbers because they're fake. And one thing that I found that was interesting here was, this is just over the past couple days, and you will see the dollar has really come down significantly. Something to note. And then last but not least, you can look at the chart on the left-hand side just briefly. Inflation versus deflation, asset returns. Deflation seems to be taking the lead on that one. But I want to focus on the chart on the right. US versus global, excluding US equity returns. When you look at global equities and subtract the US from it, look at this. Financial crisis, we haven't even got to that same level on a global level. Sure, there have been some stocks that have far surpassed their previous highs during the financial crisis, that's for sure. But it is US stocks that have risen dramatically. And many people would say that's great because I'm invested in FANG stocks. I know that most of the people who are really bullish right now have been investing in FANG stocks and other tech-related stocks for the most part. They don't really have a diversified portfolio unless it starts with the letters F, A, N, or G. And that's not a good thing, because we had seen all of that narrowing down, all of that, maybe you want to call it a bottleneck, that will ultimately be a problem for a lot of people. This isn't good when you can see that one particular market is really, really hot. I mean, you saw this back in the 90s, if memory serves correctly, with Thailand. All the hot money was flowing in. They didn't even want it. They couldn't even control it. And money was just flowing in. And what happened? Obviously, we had a big crisis in Asia. Look at the devaluation of currencies that we have seen all around the world, where you can see markets have increased significantly. But the question is that I want to finish off today. Where do you put your money? You know that the dollars are being completely eradicated in the central bank monetary easing. Where do you keep your money? And the answer is real assets. Real assets will ultimately hold value over time. And some real assets provide you, any smart investor will be able to diversify and be able to provide themselves with an income every month, maybe every quarter, depending on the type of investment. And that is so critical, more now than ever. So what I suggest to everybody is that they look into the options here to take profits from any asset that they may have been able to gain some profits off of over these years and put them into a sector that has been, let's say, hurting over the last little while. Now is the time to redistribute everyone's portfolio and not have it all focused, all the eggs in one basket. That's all for this video. If you found it informative, please give me a thumbs up. Last but not least, if you found the video informative, I know that you will find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. Links are in the description below. Take care.